Well, overseas stocks are struggling today, as we've shown you a couple times in our market checks today. Let's head to London for perspectives on the markets and the rise in the U.S. dollar. Joining us is Ashraf Laidi. He's CEO at Intermarket Strategy. Ashraf, it's great to speak to you again. Thank you very much for being available to us. One of the strong trends in the market that we've seen since April is the remarkable run in the U.S. dollar, the gain in the U.S. dollar versus other developed market currencies. You think that story is getting played out? Why?
Yes, Paul, because we've seen, I think over the last month or probably 5 weeks, there's been 4 or 5 attempts for the U.S. dollar to resume and to extend its 7% retracement, which has been part of a 15% decline in the dollar that started in early 2017. And in February, we saw the bottom in the dollar starting to peak. It was a perfect storm for a rise in the dollar. It was a sort of a pause or a dovish stance by the ECB. It was the emerging market sell-off, which really put in safe haven gains into the U.S. dollar, and there was the big rise in average hourly earnings, which turned out to be not conclusive, and that pushed up yields. But Paul, here is the thing: whether you take the U.S. dollar index, which has been unable to break above 95 at 20, whether you take the euro dollar, which has been holding above 116, or you take the U.S. yields, the 10-year yield. So I'm giving you an inter-market approach here to the things that help the dollar. U.S. 10-year yields have not made it above 2.87. So I'm speaking about the market levels that have shown us that the dollar has been unable to break. As for the whys, there's probably 3 major reasons. One of them is the symmetrical goal to inflation by the Fed. The Fed said, just as we have been willing to leave inflation going 0.5% below the target, below 2%, we are willing to see it around 2.3, 2.4%. This means they're not going to accelerate the rate hikes beyond December. The other thing, with the euro being so cheap and oil prices being so high, that means inflation is going to come sooner than expected in the Eurozone, which means the ECB is going to raise rates, is unlikely to wait until, let's say, next summer or next fall to raise rates. So with the jawboning from the ECB, with the lack of a rush by the Fed to raise rates because they're willing to see inflation around 2.4, 2.5, and so these are key issues. And the other thing is the Chinese, enough is enough. They've let their currency depreciate and fall. And I think the level that you need to watch, Paul, in your program is around 7, is the 7 level, is the one to the dollar. I don't think the Chinese are willing to let the Chinese yuan fall below the 7 level.
So Ashraf, how many more rate hikes are anticipated for this year in the U.S. and what about next year?
Yeah, it's a tough one. Maybe you can tell me your view. I think the market says that the Fed can get away with 2 rate hikes. Now, we can take away all this rhetoric, all this anti-rate hike rhetoric by Trump, which I don't think is going to affect things. But what will affect things if average hourly earnings do not continue to rise above 2.7 or 2.8%. So what I'm saying is that right now, 2 rate hikes, which I think it could happen, is a given. And I think that in order for the dollar to accelerate higher, it has to see clear evidence there's going to be further rate hikes next year. But more importantly, a sort of a pause by the ECB where to say, oh, something gone wrong, inflation is coming back down. And the other thing is for the Chinese to be able to get away with further devaluation of the currencies. But remember what happened when the Chinese were able to allow their currency to devalue so much, August 2015.
We have less than 60 seconds left. What does the current trade environment mean to the path of the Fed or the ECB?
I think the ECB, the Fed, like I said, they're going to have to really watch the average hourly earnings. The earnings is key, and inflation. The ECB, I think that, look, inflation has headline inflation has gone back to the target of 2%. What they need to see is the core inflation. So as long as core inflation goes back towards 2.3, 2.4, I think you're going to see some unidentified sources from the ECB saying that we could look into a rate hike in spring. So I think that we could gradually go back in the euro dollar towards 122, 123. I think the only pair in the dollar that could get away with further gains, maybe dollar yen. We could see a retest of 114 before we can come down. But yields, Paul, yields is what you need to see. Why aren't they able to go above 2.87, 2.88? And that's the key. And as long as they don't break above that, the dollar is not likely to break higher.
Ashraf Laidi, thank you very much. He's with Intermarket Strategy in London.